Quit your job with these 2 ETFs. A simple plan for $17,000 a month passive income. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this honest, valuable information for free. Now let's continue. Imagine waking up on a Tuesday morning, not because an alarm clock screamed at you, but because the sunlight hit your face. You realize you don't have a commute, you don't have a boss to answer to, and your brokerage account just grew by several $1,000s while you were sleeping. For most people, this sounds like a dream, but for a growing number of strategic investors, it is a mathematical reality. The problem is that most of the financial advice we hear is centered around working for 40 years and hoping the market treats you well in the end. But what if you could flip the script? What if you could build a dependable, high-yield income stream that pays you enough to quit your job using a simple strategy that only involves 2 specific exchange-traded funds? To truly master this and reach a target like $17,000 a month in passive income, we first need to understand that the goal isn't just about accumulating a pile of cash. It is about building a sustainable cash flow machine. Most investors make the mistake of focusing solely on capital appreciation, which is great for seeing big numbers on a screen, but it doesn't pay the mortgage or buy the groceries unless you sell your assets. When you sell, you reduce your future earning potential. The strategy we are discussing today is built on a foundation of dividend growth and reliable yield, allowing you to live off the distributions without ever touching the principal. This is how you create generational wealth and true financial freedom. When we look at the landscape of wealth management and income investing in 2025, 2 power players stand out for their ability to balance risk mitigation with aggressive income generation. To succeed at this, we are going to look at a strategic combination of the Schwab U.S. Dividend Equity ETF, known as SCHD, and a total market growth engine like the Vanguard S&P 500 ETF, or VO. By pairing these 2 specific assets, you create a diversified portfolio that captures the best of both worlds: the consistent, rising income of blue-chip companies and the massive growth potential of the broader economy. The first pillar of this retirement blueprint is the Schwab U.S. Dividend Equity ETF. The reason high-net-worth individuals and seasoned income investors favor SCHD is its rigorous selection methodology. It doesn't just pick stocks that pay dividends. It identifies companies that have the financial strength to keep paying and increasing those dividends for decades. We are talking about companies with strong cash flows, low debt-to-equity ratios, and a history of rewarding shareholders. When you own SCHD, you are essentially owning a slice of the most profitable, cash-rich companies in the United States. This fund has continued its streak of dividend growth, making it a cornerstone for anyone looking to replace their salary with reliable payouts. However, relying on just one fund can create concentration risk. To build a robust retirement income strategy, you need a second engine. This is where a fund like VO comes in. While SCHD focuses on high-quality dividends, the Vanguard S&P 500 ETF focuses on the 500 largest companies in America, including the massive tech giants that drive innovation. Many of these companies reinvest their profits into research and growth rather than dividends. By holding VO alongside SCHD, you ensure that your total portfolio value continues to climb, protecting your purchasing power against inflation. This combination of dividend growth and capital appreciation is the secret sauce for reaching that $17,000 monthly milestone. Now let's talk about the transformation. how you actually get from where you are now to a place where you can quit your job. It starts with a shift in mindset from a consumer to an owner. Every time you buy a share of these ETFs, you are buying a tiny piece of thousands of companies that are working around the clock to make you money. To reach $17,000 a month, you have to understand the math of the dividend yield and the power of asset allocation. If your portfolio has an average yield of 4%, you would need a significant amount of capital to generate that level of income. But here is the beauty of the process. You don't need all that money today. By utilizing a dividend reinvestment plan, or DRIP, the snowball effect takes over. Your dividends buy more shares, those shares pay more dividends, and the cycle accelerates. To maximize your long-term efficiency, you also need to consider the tax-advantaged accounts available to you. Professional investors often utilize Roth IRAs or 401ks to shelter their dividends from capital gains taxes. Imagine receiving $17,000 a month and keeping a significantly larger portion of it because you structured your portfolio correctly within a tax-efficient framework. This is the level of portfolio management that separates the amateurs from the professionals. Even if you are starting from zero, the goal is to begin the accumulation phase with a growth-focused mindset, gradually shifting toward an income-focused strategy as you approach your target retirement date. To truly succeed at this, we have to look closer at the specific metrics that veteran income investors prioritize, concepts like yield on cost and total return. These aren't just technical terms. They are the indicators that tell you if your portfolio is actually growing your purchasing power. Yield on cost is particularly powerful. If you acquire a position today at a 4% yield, and that underlying company increases its dividend by 10% annually, your personal yield on that original investment could be 15 or even 20% a decade from now. This is how a modest investment today transforms into a massive income generator in the future. It is not about timing the market. It is about time in the market. Another critical component of this wealth-building machine is understanding dividend durability. In a volatile market, many high-yield stocks are actually yield traps. Companies that pay high dividends because their stock price is crashing and their business is failing. By sticking to high-quality ETFs like SCHD, you avoid these traps. The fund's methodology automatically filters out companies that show signs of financial distress, ensuring that your income stream remains stable even during economic downturns. This defensive nature is exactly why institutional retirement planners favor this approach. To reach the level of $17,000 a month, you must also be aware of the importance of keeping your investment costs low. This is why we focus on ETFs with low expense ratios. Every dollar you pay in fees is a dollar that isn't compounding for your future. Both Vanguard and Schwab offer some of the lowest fees in the industry, meaning more of the market's returns stay in your pocket. This efficiency is a core part of the simple plan. You are cutting out the middlemen and the high-priced advisors and going straight to the source of American economic productivity. So, to summarize what we have discussed, the path to quitting your job isn't through a lottery ticket or a risky side hustle. It is through the disciplined application of a 2 ETF strategy focused on dividend growth and total market exposure. We've looked at why SCHD provides the reliable income foundation and how VOO provides the growth engine to keep you ahead of inflation. We've explored the math of the dividend yield and the transformative power of the snowball effect. The biggest takeaway here is that financial freedom is a choice made through consistent, automated actions over time. If you are ready to take control of your financial future and start building your own $17,000 a month passive income stream. The first step is to simply start. Whether it is $100 or $10,000, get your money working for you today. If you found this breakdown of the 2 ETF strategy helpful, and you want more deep dives into how to build a high-performance income portfolio, make sure to subscribe to the channel. I would love to hear from you, so leave a comment below saying the video was helpful, or let me know which ETFs you are currently holding in your portfolio. And finally, if you learned something new today, please click that thumbs up button to like the video. It really helps the channel grow and allows us to keep bringing you this kind of high-value, educational content. Disclaimer: the information provided in this video is for educational and informational purposes only and should not be considered as professional financial, investment, or tax advice. Investing in the stock market involves risk, including the loss of principal. Past performance of any ETF or stock is not a guarantee of future results. Please consult with a qualified financial advisor or tax professional before making any significant investment decisions.